Welcome to the New Barbarians podcast. I'm Bill Mann.
And I'm Mark Connors. And we're here to deliver insights on how current market events impact the traditional investment portfolios of stocks and bonds that Bill and I traded on Wall Street. Today, we see digital assets as the next frontier for finance and investment.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So instead of Mike Milliken's innovation on debt financing with junk bonds, today's barbarians at the gate are changing the landscape almost daily across regulation, legislation, and finance.
So hit the subscribe button and let's cut through the noise together. Welcome to episode 13 of the New Barbarians podcast. Today is Monday, March 24th, 2025. The podcast will hit the platforms later than usual, tonight or tomorrow morning. Markets rebounded to end last week more or less flat, and today the markets took off following news that Trump's tariffs will not be as significant as projected. The Dow is up 1.4%, the S&P 500 was up 1.8%, the Nasdaq the Russell led with 2.6%, and Nasdaq was up 2.3%. So, we've seen a return to risk taking and higher beta stocks are performing today. The VIX was down 9.4% to 17.46. And then monetary policy continued driving headlines last week as the Fed, the Bank of England, the Bank of Japan all held policy meetings. All three banks kept their respective policy rates unchanged. However, the Fed slowed its pace of quantitative tightening by $20 billion, reducing pressure on Treasury market liquidity from the Fed's gradual balance sheet reduction. Mark will explain what happened with Fed tapering, as well as the usual scorecard across assets and markets.
Awesome. Thanks, Bill. It was definitely a reversal. I don't know if it was positioning, but there's not a whole lot of news. Obviously, as you said, with the Fed, the biggest takeaway is the reduction in the amount of treasury that they sell every month from 25 billion to just 5 billion. Now, they're still selling about 35 billion of agencies and mortgages, though, back in the market. But that distinction about only selling 5 billion down from 25, I think it was as high as 60 billion a year ago, is meaningful because they're going to be selling treasuries from the Treasury. So the Treasury doesn't want to be competing with the Fed when that debt ceiling gets raised, which we're going to talk about a little later. So a little bit of brinksmanship by the Fed, not unexpected, but still it'll hit markets April 1, no joke, and that'll be one day before the tariffs hit. So the coordination across policy is nothing short of legion, because we are dancing a thin line here given the disruption in markets brought on by Trump's tariffs. So let's hit the scorecard, as Bill said, because it doesn't matter what we say. Let's see what the markets have said about pricing winners and losers over the past 5 days. Here we go. So on a month-to-date basis, we had a shift. Bitcoin rose up. Bitcoin, gold, and the non-U.S. equities think, the DAX is up 20% this month. I'm sorry, year to date. Chinese stocks rebounded on a couple issues. The impairment in the U.S. on the equity side is almost by design with the tariffs and with Trump's the Doge taking out tens of thousands of jobs, which is basically income in the Washington, D.C. area. So month to date, big reversal. Bitcoin is down as much as 6 to 8% on the month. So big reversal, bringing it down 6% on the year. But gold's the story between our last call, Bill. I think gold was under 3,000 over the past week. It breached it with a flourish up to like almost 3,050, almost hit that level, and that's persistent. So we think the Fed news about quantitative tightening, reducing, which is basically tapering on the treasuries, is setting up for more debt loads coming on. Now we're gonna touch on that in a second. So this, looks like you're on the LIE. It's summertime, going to Hamptons, but this chart is chaotic, like the LIE, for good reason. The tariffs were not realized, or the impact of tariffs, until we got to the end of February, and then there was a separation of risk assets, growth oriented. Think the black here is oil, still down 3.7% on the year, but obviously was down as much as 8%. Bitcoin still down, risk asset here. Nasdaq, and of course, last year's winners, Mag 7, still down almost a little over 10%. Gold, the haven, non-U.S. equities up. And then sort of, splitting hairs here is the 7-year to 10-year Treasury ETF up a little bit on the year, as is the bond index. This is what we think will continue. We think we bottomed a bit. I don't think we're in a full-blown rally. I think the markets do what they do. When there's an uncertainty, like the Bank of Japan reversing policy in August of last year, after the Nikkei had a down 9.8% day, the biggest since 1987, markets sold off in August, again, down to that magic 10 to 13% number. We saw a likewise number in 2023, in July and August of 23, after that rough first quarter with the banks. So let me go to the next slide here. This is why we think what's going on, and we might have showed to this last week, but there's a new data point. We know that Trump has walked back from NATO funding. Pay your fair share is his mantra. 3 to 4% of, or 5% GDP. Well, folks, Germany's doing that. Germany has passed a bill not for 500 billion, but for 1.1 trillion of infrastructure and military. That was twice the expected amount, or they pulled through and put the passage. If that goes through and the funding happens from debt, it will raise Germany's debt to GDP from 60% of GDP to close to 90% of GDP. And that is a sea change. The Bundesbank was the only adult in the room in Europe. Frugal, fiscally sensitive, that's out the window. By pushing the funding of NATO back onto the European partners, even if U.S. is going to remain in NATO, has had a impact on markets that we haven't seen really in decades. You're looking at the DAX here up 20%. You're looking at the 10-year Bund, the yield up 20%. We don't usually show yield, you show performance, but you're looking at the yield expand because of fiscally led inflation. And meanwhile, what did the dollar do? Dollar down. Nasdaq down, US yields flattish on the year. So you're getting what Scott Bessent wants is an acclimation period. There's going to be pain in the equity markets. He wants a weaker dollar. He wants lower yields. He's going to pump more oil, drill, baby, drill. His 3 billion barrels, 3% growth, and a 3% deficit is, you can't say he may not achieve it, Bill, by the midterms, if he's going to put this military cost shift back onto the Europeans and away from the U.S.
But I guess what's interesting is that I'm not very good at paying attention to the news. I guess that's pretty common in quant land, but I don't feel like I've seen a whole lot out of Europe other than, these announcements. But what's the economic outlook in Germany? I can understand why their bond yields are going to go up. People like the stock market, but economically, is Europe kind of in the same boat as us in
Yeah,
terms of GDP
yeah,
growth? And
yeah. Growth is being marked down, and this is the tightrope that they have. I don't know if you're going to call it a Gordian knot or just a pickle that they're in. Europe, the ECB last lowered rates because they're sensitive to growth. Because obviously they've had lower growth. They're either side of between 0 and 1% GDP targets, and that's tough to make up on volume. It's a very thin number, especially with the aging population and the retirement pace. But Germany's entering a period of fiscally led inflation with their spending program and the pace of it. So it's almost like a wartime act that's going on right now. And with that comes inflation. So this is in our green room, we were talking about the great experiment that is the EU and the euro. They did it for a reason. They created the second largest economic union behind the U.S. on the planet, and without it, they'd all be a fractured, loose confederation of warring tribes like they had been. But with it, they have an economy that is just behind the U.S. in terms of nominal GDP. But the problem is they have a fiscal disunion. They each fund themselves differently, but they have a monetary union. So they have a common currency. It's almost like putting different species, or not species, different plant types. Pardon me, Darwin. I missed that class on what you call different types of plants. Different flora or fauna in the same greenhouse with the same temperature. Not everyone's going to live very well, and that's what's happening. Germany's dictating it right now, and they're saying rates are going higher, inflation's coming. That's going to hurt countries that are not experiencing growth. It's going to hurt Germany. It's going to hurt their economy. So what do we have? We have fiscal dominance. We basically just exported inflation with that move.
that's what I was thinking. It's bad for them playing catch up with some of what's happened in the US with inflation and, obviously blowing out our debt over decades. But medium term, I think that the US will look okay, Europe will look less okay. And so, even what we've seen with investment, equity investment flowing over to Europe probably won't last very long.
No, I don't. With purchasing power parity or interest rate differentials, that there's no arbitrage, and that's going to be coming back. So those temporary safe haven flows, which is why we still like on our Mr. Mentions part, gold and Bitcoin for sure, because I think, and we'll talk about in a minute, that the fiscal dominance will require more debt funding. Just look at. Let me see. This is. I got two charts here. Let me pull up. I did the old Google search here. So we did tariffs. So let's look at tariffs over time. Top chart, last 10 years. We know what happened in 2018. We know who was president then. It was about technology and chips. So that was the largest what are tariffs search that we had up until that time between 04 and 18. But it's dwarfed. Why, we always think about Brexit. We did something, we don't know what it means. Well, we're doing tariffs. I believe that Trump does know what the game plan is. And I think that Scott Bessent does know. what the game plan is. But we don't. And that's important because the economy is 70% consumption. And if people aren't certain about what's happening with this new animal, tariffs, or this expanded use of tariffs that is on the scale of Smoot-Hawley, and we're not being, 1930s, that's not hyperbolic language. The scale of it on a dollar basis is much greater than 2018, what you're seeing here, and greater than any period that I believe since 1930. To be seen, I guess, because April 2nd is when they roll out, and maybe since they're retaliatory, if they're waived in Canada, China and Mexico, then maybe they get rolled back. Maybe the negotiating tool works and we don't have the tariffs. I don't think so. And then the other one the one that really matters here is recession. So I think that recession that's when you have real destruction. You have real destruction of jobs, economic value, and obviously that's when you go equity market down 20, 30%, not 10 to 13. Here we're looking at the search over the last 10 years, and surprisingly, including the GFC, which is just amazing, only when the Fed was raising rates from 0 up to the 500 basis points over that June-July period of 22, that's when we all thought we were going to recession. And we didn't have a recession by definition. We think there were rolling recessions back to the K recovery. Some businesses were hurt more than others, but only now, Bill, are we starting to have some resurgence approaching 2022's level of clicks on what the hell is a recession. So I don't think we fully appreciate the price impact of 10 to 25% goods and services increases on imports. And obviously we're a huge importer. We do not manufacture much anymore. So I think we're still digesting. I think it's a bumpy road. I'll turn it back to you. But as we agreed or we came to the same conclusion, we think for now markets have, dove low to ground and are saying we've put a intermediate low in the market. Now we're going to digest some economic information.
A lot to digest there, and I think we do agree that we must have at least bounced around a temporary bottom. And I think this administration is going to support the markets, and we've said that many times. But this almost looks calculated the way we flushed the equity markets a little bit, but nothing too damaging. Tariffs may not be as disruptive as we expect, and I think if they do stay around, that's also at least from our administration and its global counterparts, kind of an understood thing. They've been projecting it for months before it ever happened, and I think everyone's going to be able to settle into it. One thing about Google Trends, it looks like maybe asking the world to dictate fear of recession is maybe asking the wrong crowd. I don't know. In October of 2022, when rates went up to combat inflation and the economy wasn't looking too good, right? I guess that's the difference. But when we raised rates to slow down the economy, that's a lot different than what happened then. But yeah, but it's just crazy to me that there was more interest in 2022 than there had been in 2008. I guess I'll just leave it at that.
I think we have to remember the iPhone came out in 07, so mobile use was lower. So it doesn't, I think we do have to sort of put some not Windsorizing. We had to do a Garch approach on this
Yeah.
and discount the later data, relative earlier because of people weren't using it as much as a resource, I believe, or as frequently.
I think that explains it perfectly. There's sort of a break in the data because people wouldn't have been using Google other than like at work and
Yep.
you know.
Yep, definitely changed, which is what we try to do here. Bloomberg says context changes everything. I don't believe that. I think context enhances everything and gives you a finer point and a clear conclusion. And that's what we just did there, basically the perspective. When go ahead.
Yeah, I was just going to recap a little bit about factor performance in equities, but finish your thought.
So let's go look at. I'm going to touch on something, and it'll be a setup because we obviously went through a big reversal today. You're going to go through that with factors. So what I'm going to talk about, everyone's looking at recession. Sorry, at tariffs hitting, and tariffs are coming, I believe. They're not going to be rolled back. They will be a cost shift to the consumer for portion or all. And, I think the administration looks at it as a regressive tax where the wealthy will be able to afford it and pay it. Others will substitute. And that's one way of having the external revenue source, which is an odd name because it's paid by U.S. entities, to have it helped reduce the wage gap or the wealth gap that we have in the U.S. To be seen.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe. It really helps us grow the podcast and bring you great content. Thanks for the support.
But here's something that's coming, to a theater near you, like we had 3 years ago or 2 years ago. What you're looking at is the black line is the tapering of the Fed's balance sheet. Here's the axis, as high as $9 trillion back in 2022 before they started tapering. The blue line is the Treasury general account. That's basically the Treasury issues debt, puts the cash with the Fed. They draw down on it to pay out deficit fund, etc. That's their piggy bank. The Federal Reserve, their balance sheet or securities, when they reduce it, they're selling securities back in the market and taking cash out, extinguishing it on their balance sheet. So they're withdrawing cash. So let's look at what happened here in 2022. Both lines are going the same way. Treasury's drawing down. Why? Because they're going into that debt cap. Remember, in 2023, there was a cap on the amount of debt that could be issued, and they had to waive it. And I think in June they finally approved an increase in the debt ceiling. But it was too late because the banks, with the rising rates and the reduced liquidity, we had 4 banks go out of business, and that caused the Fed to inject $400 billion through the bank term funding BTFP to save and stem the losses of contagion going forward. The Fed was taking cash out of the system. The Treasury was running out of cash. Banks failed here. Only $230 billion left. Remember, they're basically providing fiscal stimulus as a Treasury because they can't issue debt. They got to drain down their piggy bank. Fed had to backstop, $400 billion. It's not the same scale. So this is $400 billion in a matter of 2 weeks. The Treasury only had $400 billion left in their whole piggy bank at that time. So they backstopped them. Look what's happening again. The TGA has gone from $800 billion, almost cut in half, in a matter of 6 weeks. What do we have? We have a debt ceiling in place that's going to hopefully be addressed by June. We don't know. So buckle up, folks. It's why we think Bitcoin is running, why gold is running, because we believe there's another print coming by the Fed, by the U.S. Federal Reserve, in order to backstop the Treasury being limited in the debt issuance that they can make going forward. So Bill, the reason I bring it up is when these rotations happen, maybe look at, as you go through your factors, about what type of rotation you would expect to have, and would it mirror what we saw today if we have this sort of crash, risk off, and then a big risk on. What's the best ways to look at it, or to look at, because I think there's going to be more macro events going forward. It's not just going to be about tariffs. The Fed's going to come back and play.
So yet again, I think there are multiple things to think about. One is that $400 billion injection. I, as usual, wasn't paying as much attention, but compared to the GFC, the global financial crisis, that's a big number, right? 400 billion.
So the GFC was, the big Sunday morning on the steps of the Capitol, Republicans and Democrats holding hands, was 700 billion.
Right.
And eventually the Fed's balance sheet went from 800 billion up to 3.2 trillion. So over the next couple of years, you saw a lot of additional easing, even though Bernanke in 09 or no 08 said it'll be $1 trillion and then we'll take it down. And then it went to 3. So, we know what his word really wasn't worth a lot there. So yeah, 400 billion, not a small number. But then you say, but hey, Mark, but they took it down. Look, they took the sheet down. Yes, because we increased our debt by over 2.5 trillion in the interim on a nominal and deficit basis. The Fed walked away because the Treasury said, thank you, I'm back in business. The debt ceiling was removed. We can now print and fund ourselves through deficit spending and backstop the slowing growth, which is basically why we don't have recessions anymore, is because the government is funding industries. As we said, healthcare is over a third of the job gains in the past 12 months. And guess who's funding healthcare through the, $2.5 trillion deficit, 7 going on 8% of GDP.
I'm not sure how housing is performing everywhere, but it's still doing very well here, and it's certainly been going up ever since the short 2-year somewhat correction in the housing market after the global financial crisis, which was driven by a bubble in real estate, supposedly. But yeah, I guess rather than debate how long can the spigot just be left on, we will just assume that it's going to be left on, and that's good for assets, including equities.
It is nominally, right? Because it's a monetary ratchet. It only moves one way. But for the folks who are active managers trying to create alpha for a living instead of just being beaten every month, every year by a 3% basis point ETF called VU or SPY. When you're looking at factors, can you go through how do people, are they chasing performance even as a quantitative fund, or is there a way to actually produce a differentiated return profile given this backdrop, or just given what's happened?
So I think alpha is defined as, making money in an up or down market, basically. It's also arbitrage. So, you should be making risk-free returns if those opportunities exist.
Mm-hmm.
And so the portfolio construction process for quants is meant to do that. It's actually meant to generate alpha regardless of what happens in the market. It's not like you're typically trying to beat a benchmark if you're an absolute return fund.
Yep.
Of course, there are vehicles and products that, you know, target beating a benchmark and they bet on the same securities in the benchmark and try and do better. But in the absolute return fund, I think, you know, generally speaking, if you're betting on enough things across enough assets, sectors, and risk premia, you should be able to exploit dislocations among them. So the obvious one there when we're showing the Fed and central bank behavior is finding value in, you know, hopefully, you know, you have the capacity and the access to do this globally across all different assets. But, you know, I think there is a relative value trade. You can buy inflation protected securities and find, you know, basis and dislocations among and between these different assets and issuers of them, so central banks. But this looks like an inflationary market, right?
Yeah.
I think, you know, that there are factors that help you bet on stocks that benefit from inflation, and you can bet against stocks that do worse in inflation. But across regions, sectors, and risk premia factors, I think it's really hard to just say, yeah, you pull this toggle, you push that one, and, you know, you kind of optimize. But I do believe, and, you know, volatility is sort of good when you can react and reposition your portfolio before others do. But what we did see recently is, you know, oil price sensitivity did well, inflation sensitivity did well. So it seems like the markets and the players are kind of back to where they were before this crazy, you know, was it just February? It seemed like longer than that, but, you know, into March now, a couple of weeks, but I don't know, the whole sell-off was 6 weeks maybe.
Yep. I think
and so
February 19th might have been the peak for the Nasdaq, which is
okay,
funny.
yeah, so it's even shorter than that. It seemed a lot longer.
Yeah.
And, you know, I think catching up with you and doing this podcast is forcing me to keep an eye on the markets a lot more than I used to. But this was not, you know, a prolonged sell-off that was, you know, you have two things that can happen. You can have a sell-off or, you know, contagion from fear of recession, or it can actually enable a recession and cause problems when there's, you know, severe dislocation and sell-offs in the market. So I don't know, this seems like a relatively short, assuming things have kind of bottomed and they bounce around here for a little while. It seems like maybe the flush of the equity market and what everyone considered overvalued sectors and the stock market itself. But that's what I feel like this happens every year, maybe every 2 years. And then next thing I know, we're setting new highs again.
Yep. And as we said, unless we have a credit default cycle kick in, which, you know, maybe we'll touch on that later, but some folks are calling for it, but there's credit spreads are certainly not signaling that for sure. But why don't you show us, we had a big move today in markets. You kicked off the show with that. Can you give us some context for the scope of those moves and maybe the duration? Does it mean that these things have a persistence? You know, do you have any indication using your models to give a window to the folks here on the persistence of today's pretty big move?
That's a really good question. I wasn't actually putting it in that context. What is the persistence of these based on the statistical significance of today? But, the short answer is nothing was really above a 2 standard deviation move across sectors and risk premia. So, the quality factor, sales growth was up almost 2 standard deviations. Reversal and momentum were also not quite 2 standard deviations. We saw huge beta moves. Small caps led the market, and then tech, and then the S&P, and then the Dow. So it was really just
Seems like a whipsaw, like a
yeah.
catch up, right?
So the more risky, the better for today. But those weren't those weren't huge moves. If you look over the last 12 months of volatility, or however we're calculating this, but I would think that does lead to the chance that they're persistent. That you could say a huge gain today leads to gains tomorrow, but I actually think if we see moves like this, it is a big move percentage wise, but not really when you consider markets that have been up 25%
Yeah,
in a year. So
that's a great point. And as you said, we went down hard from February 19th. We're now, as we saw with that squiggle graph of, I call the LIE on an August Friday, of all those returns just ramping up after the past week or two, all the risk off assets improving. A 2% move in a multi-trillion-dollar company would have been a big deal, prior to COVID. But since COVID, and certainly in the last year, because that's what your model does, right? Last 12 months?
typically, yes.
Yeah, okay.
Yes.
Well, in August, which is less than 12 months ago, we had a huge move down.
Right.
We had that. So that's in the data. So I think it's put the mouth guard in and strap in, because given the tectonic plates that are shifting with this military cost shift to Europe from the US, I think we're going to have more 2% days. I don't know what direction they're going to be, but just from a fundamental standpoint, you're modeling. I'm just taking it from a global economic shift in payers for the military complex. That's huge, and we're still digesting it, as we saw from the Google searches by our comrades in front of their phones, trying to figure out what it is. Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support.
And now that I'm looking again, I also realize I almost misspoke. Sales growth did well, but that isn't really quality. That's growth. So growth stocks and high beta names, high risk assets are back on in style as of today. And of course, we'll probably have gyrations, and it's probably not going to return to the all-time high in a month, but I feel pretty good about today. And in the last few weeks, I think we've mostly been talking about, okay, this is kind of scary, but we don't see real contagion.
Yep.
And we probably should talk about that credit publication that we saw. That was actually, I think, at the beginning of this month or a few weeks ago.
Yeah, a few weeks ago. Yep.
And sort of debate what that means, because I think equity implied credit is a little scarier than what the rating agencies are saying or what we'll actually observe.
Yep.
I don't expect there to be, a lot of credit events, even though, if you look at a Moody's KMV report, it looks like, they're I almost worry that that is clickbait to publish something that says, default probabilities are up materially, and I believe it was 9 or 10%.
Yep.
So when you do a Merton default risk model, you're basically using equity and you're looking at the amount of debt on the balance sheet. And so it's market cap versus debt basically, but you also use a barrier option pricing
Yep.
model to forecast the probability that the market cap will keep going down enough, and then eventually you'll break this barrier and the debt holders will exercise an option and take over the company.
Mm-hmm.
That's kind of the theory. And when you have a lot of volatility and falling market caps, that just raises the probability of that happening. And what I think the timing of that report was probably after like 2 weeks of this sell-off. And it seems like it's just interesting when you look at that graph, and we should get into this more in depth later, but it seems like the quants that are doing credit sort of persistently believe that investment grade credits are worse than junk.
Yep.
And that's, the exact opposite of what their rating agency is saying. So Moody's bond ratings are saying, default probabilities, until you get down to B or like 2% over a year.
Yep.
And, up to, 9% over 4 or 5 years for single B.
Yeah.
So deep into junk territory. And I like the Merton model. I worked on it for a couple of years at Bloomberg, and I think it's a great way to look at relative value with credit and to compare different companies in a sector against each other. But I don't really think that it's realistic to think that 10% of the investment grade universe is going to default, or else we would all be in huge trouble. And, I would be preparing to, live in the woods or something, because that didn't happen in the global financial crisis. Nothing like that has happened in my lifetime. So,
yeah.
I don't, that is all a very long way of saying I don't see a credit cycle, blowing up anytime soon. We just haven't observed it. The VIX is down a lot, and it wasn't even up to a crazy level.
Yeah.
So
that's a great distinction, because this is Moody's research group, as you made that distinction, not the ratings group. And let's take a look at it, since you've spent time discussing it and we happen to have it handy here. So and the rise wasn't as much in our recent sell down as it was in the rate hike. So it's almost as if the rate volatility, which did impact equity prices, obviously, in much more than it did recently, because they were down 22, 25% in 22 or more. So small and mid caps got hammered, and that would have raised, lowered the lambda or raised the potential for that capture of value by bondholders, as you so accurately gave the description of the model. And yet high yield companies, so the value that I get out of the report is here, whether it models out to 9% or not, unlikely. The value of the model is that it's weighing and giving credit, pun intended, to the high yield companies, which are lower rated than the all public companies, which include many investment grade, because high yield term out their liabilities, or they use 5 or 7 year bonds, versus smaller cap public companies tend to use short-term loans that are subject to rises. So the model is sensitive to that. And so we would definitely have to put our tin hats on and go down the quant rabbit hole in order to look at the difference between the scoring model of a rating agency versus this Merton approach. But that's what I get out of this. And I
And
think
and sorry, I do like that observation. My comment about 10%,
you're at,
nine
yeah.
percent of companies defaulting in a year is not going to happen. But I do like the explanation for this, which is you know financing with loans, floating rate debt, potentially increasing rates, just volatility around their interest expense is harder to predict. But if the high yield companies are terming out their debt at good rates and you're comfortable that they're going to be able to meet their debt service, I think this kind of says the same thing. We won't expect defaults even among
Lower
you know
quality.
low quality bonds. So of course we're not expecting it with all public companies, and I actually mistook this, that they all public would include non-investment grade as well as investment grade.
Yep.
But generally I think that this is an interesting analytic, and it gives you a lot of information about relative value among these different types of companies. But yeah, this kind of tells me that high yield companies are pretty safe.
Yep. And back to your point, relative value, credit. I mean, rate volatility is a great destabilizer. So the relative value credit hedge funds definitely have it looks like an ability, even walking down the reality of a 9% default rate a bit, have the ability to differentiate here based on getting long or short credit of companies that are floating, either through a derivative or otherwise, versus getting long, termed out high yield bonds. Especially if Scott Bessent does what he says he's going to do and going to drive that 10-year lower. The floating rate loan people don't benefit from that LIBOR based product, but a fixed income sure will.
And I think going back to your previous roles, capital structure arbitrage is probably alive and well right now. I imagine there's a lot of different value if you're willing to look deep among companies and the different assets that are associated with their capital structure. You know, you can capture some of this with options, bonds, equities.
Yep.
But there must be a ton of relative value.
There, yeah, and it all goes down to the interest rates. When interest rate volatility happens, moves again, those low levered, low volatility assets, currencies, rates, and high yield credit or high grade credit, when they move faster than expected, like they did in 22, things break. And we haven't had that happen in 24, 25. Rates have been in a band. They haven't really hit a new regime yet. You did see it in currencies like Japan, and that's why the dollar had to weaken, which is what we wanted. That stabilized markets. So we'll go back to it. Dollar stays weak, markets will stabilize. We can have the cost shift happen from the NATO rewrite, and we may not, wake up the credit beast to have another default cycle like we had in '08. Or the briefly, albeit in 2020.
Cool. Well, we did a little bit of a deep dive into that particular credit report, but since we talked about it ahead of time, and I think it will certainly warrant more of a rabbit hole type of deep dive later on for people that are interested in different ways of modeling credit and, fixed income investing, corporate bonds. But that is all a long way of getting to the same answer, which I believe is, even though we don't give investment advice, we are starting to feel more comfortable with risk on.
Yes, we are. And I would say, obviously, if you're going to ask me, it's going to be Bitcoin is built for this technology base. You have regulatory changes. You had the digital asset roundtable by the SEC, the first one, crypto roundtable, they called it, I believe, with Hester Peirce leading that charge. And not to mention the digital asset summit in New York City, where the first time you had a sitting president address a crypto event. Yes, Trump spoke at the Bitcoin conference last July, but he was a incumbent, or he was a candidate, not a president. So you have a lot of good news happening there, and adoption's, I think, well on its path to continue.
So I'm going to have to be a fly in the ointment for a moment, though. In a few days, March will be over. I believe that does mean Bitcoin will be down for a quarter.
Is it still secure? Is it decentralized? Has anyone copied it? These are the kind of standards that we look at, and no, it still is, 60% of the whole universe. Its hash rate makes it the most secure asset. And you have folks like BlackRock only, I think, 3-4 weeks ago saying, for the first time ever, we're going to put 1.5 to 2% of it in our model portfolio. Our clients have no say in it. It's an allocation. We've made it. Now we're going to start allocating to it. They own it. So those things, and then the other subtleties, Bill. We're in the financial industry. We have friends, unfortunately, who are in finance, but we have hopefully friends outside of finance too. No one in New York, Connecticut, rarely anyone owns Bitcoin who's in our industry.
No. Although I did meet someone the other night who told me that they like trading options on the crypto ETFs. So that could be an interesting thing to look into. I imagine that can be a pretty volatile.
It's a total gateway drug. That's why Michael Saylor's company has been able to sell stock, because all of a sudden these people look at this behavior of MicroStrategy, now called Strategy, MSTR. It behaves so differently. So they're trading options. They're like, whoa, it's got a lot of positive skew. Let me get long some of that. So he wrapped his TradFi company around this Bitcoin animal that has positive symmetry. And you're right. So that's the gateway drug. People don't think it's Bitcoin. They just think it's an equity. And yes, the ETFs obviously have that same dynamic. You can buy and sell and harvest volatility all day long. And they probably don't even know who Satoshi is, Bill, do they?
Well, these ones probably do.
Okay.
But yeah, I think there are a lot of different players out there. And for people that do a lot of their own research and understand what's going on, I think they're comfortable with those types of trades and harvesting volatility. And maybe the point there is some of the retail types of investors may not really know what they're up against.
Yeah. This is a tiger by the tail. Be careful being long or short volatility. Know which way you are if you're ever going to play this animal.
Cool. Well, we did cover quite a bit today.
Yeah.
I think we can probably wrap it up.
Absolutely. And so, Bill, as we end here, where can folks see you? Get some of your research on the AI or the factors that you've had in your pulling from your illustrious career.
Sure. So I'm actually happy to announce that you just joined us on smartkarma.com, which is the independent research venue in Asia that I've contributed quantitative research, and you're now contributing macro. So smartkarma.com. And then we're both on Substack and harmonicinsights.com. And on any of these venues, you can find me at Harmonic Insights, as well as Twitter. And what about yourself, Mark? Where can they find you?
Yep, I'm focusing right now all on Substack with my work. I've been on there a year. And I'm going to post something tonight, a little bit about what we talked about here and some other items. And that's where, we try to tell stories in Substack and give links to data so that you can see where we're getting it from. We try to make it easy. We think we're in a new regime. Doesn't mean equities won't be a good place to be, but given what's happened with NATO and the cost shift, I think that's a once in 80-year move. I don't say that lightly. And, we're no longer in Kansas. So, find your Tin Man, Lion, and Scarecrow and get on the road and find yourself some Bitcoin, because I think that's going to be the place to really have a little bit of allocation. That's what we talk a lot about.
I guess one more plug that I almost always forget to give is people can also find you and I increasingly on the streets of New York. We've been doing a fair amount of client visits to talk about different things that we do and our different offerings. But I've also been at quant conferences recently, so I've seen a lot of people. I hope they follow my request and my advice, which is to subscribe, follow, like this podcast so we can keep doing this and keep growing our audience.
Yep. Amen. Hit subscribe, pound it, like and subscribe, folks. All right. Until next time.
Thank you.